the project's IRIT-based cash flows. Student, this question is on international investment appraisal. International investment appraisal it is. Okay. To estimate the project's E-based cash flows in pounds, first of all, in pounds, 8 marks. Estimate the NPV in dollars, 9 marks. So 17 marks it is. Now you see here, these two questions are theoretical, which are related to this scenario, these calculations. Okay. These two discussion is to somehow around 14 marks. It is linked to these calculations. Now, this is political risk knowledge applied to scenario, 5 marks. Now, chief officer suggestion. You know, all three types of theoretical questions have got covered in it. All three types. And this which are related to calculation, it has the maximum marks. Other two have less marks. Professional marks, let me tell you. If I say you one easy line for the professional marks, that don't have additional burden in your mind. If you are doing every calculation properly, if you are utilizing in your discussion the scenario information and calculations, it is automatically majority marks related to communication, analysis, evaluation, commercial acumen are covered. Automatically covered. Majority of the marks. That's why you should not be worried about it. So, let us start reading the question scenario. So, 4 exhibits are here. The first exhibit. M company specializes in design and production of scientific instruments. Until now, the company has never sold or manufactured products outside its home market, the United States, but the chief executive officer has identified a new growth opportunity in the country of IRIT. Although E is an emerging market, which has been experiencing extremely economic challenges in this decade, recent decade. A new government has introduced a series of promote incentive to promote inward foreign investment. These incentives were introduced after the recent election when a important factor, they were important factor behind the CEO's proposal, right? New election, new government. Remember, when we read the political risk, political stability, it is linked to the new laws and regulation, changing laws and regulations, linked to that political risk. Now, so project information. IRIT currency in the Eritrean pound and today's exchange rate is $3.31 per pound. It is assumed that the project will last for 4 years. Okay, so our first requirement is cash flows of the project in pound, 8 marks. Right. So the number of scientific instruments expected to be sold in each year is as follows. Sales. They will, okay. Now read it. M company will charge a selling price of 275 per unit in year one, incurring estimated variable cost of 100 per pound per unit. They're expecting to increase in the line with inflation. Variable cost in one already include the cost of a component which will be manufactured in the US. This component will charge a transfer price of 20 pound per unit, generating a pre-tax contribution of $10 per unit, 10 pound per unit. Both transfer price and pre-tax contributions are expected to increase. Now, this is a bit messy discussion. They have added a complexity here. So please read this sentence 2-3 times. Yes, please. So that you can understand it in a better way. Now, so the project will incur fixed cost in year one, increasing at annual rate of 5%. Now, the next point is investment cost. The investment costs include 32 million pounds for land and building and 18 pounds for plant and machinery. Tax allowable deduction is available at an annual rate of 25% on the cost of plant and machinery on a straight-line basis, with the first allowance claimed in year one. Okay, straight-line basis. As an incentive to foreigners, the government has agreed with Mckeever to act as a buyer of last resort in the event that another buyer can found out the land building at the end of year four. The cost of land is therefore expected to be recovered in the full at the end of project, but the expenditure on plant is not expected to be recoverable. Yes. Another incentive, you see incentives. To foreign investors, the government has agreed to, these are all political risk as well, if they become reversed. To reduce the corporation tax, which is now 30%, they will pay annual 20% in Emirates compared to 25% in the US. In both countries, taxes are payable in the year the liability arises. A bilateral tax treaty exists between the two countries, and under the terms of that treaty, M company will be able to offset overseas tax against any US liabilities incurred as a result of its foreign overseas earnings. The project will also require an invest working capital, 15% of that year's contribution. Okay, contribution. Assuming working capital is fully recoverable at the end of year four. Inflation is here. Okay. So inflations are given here. You have to calculate the purchasing power parity forecast exchange rates. No dividend restriction on remittance. Okay. Cost of capital 14%. Our first requirement is only calculation of cash flows. So what I'll be doing, I will be calculating it in the Excel sheet so that I can, oh my God. Can you see my screen now? You know, if you face any issue, do tell me, because I just saw that my screen was frozen. Sharing was paused. I just saw that. So do let me know when you face problem, anything, do let me know. Your silence will not communicate any issue if you are facing any. Okay, now So I'll be opening the Excel sheet so that I can start solving this question in the Excel. Otherwise, in exam, note down, you have to do this calculation in the spreadsheet here, which is given inside this one. It is similar to Excel, not that fancy like Excel. Spreadsheet is here. Now, okay, still freezing. Is that okay now? Thank you. Do let me know. Don't stay silent. Yes. Yeah. The past paper is, it is September, December 2023. And the question one, Mckeever Company. Right. So we need to calculate cash flows. One thing we have figured out when we were reading it, that we need to calculate contribution. Because we need to calculate working capital, which is based on contribution. So that's why. So starting with the workings, starting with the workings. Yes, like this. So first of all, that is year 1, 2, 3, and 4. 4 year there are number of units. That is 55,000. Then 67,000 and 82,000 and 90,000. Number of units are there. Sales. But for that purpose, we need to calculate selling price. 275, it will increase in a line with inflation. So inflation in E country. So inflation, 5%, 5%, 4%, and 4%. Okay. Now, students, sales, focus everyone. This is selling price is 275 per unit in year 1. Now, so in year 1, but the point is 1, 2, 275 into number of units sales. Yes, 275 is the selling price. Now selling price has from year, this is given year one. Now it has to increase. Selling price has to increase in line with inflation. This into this. Into this 1.05. Okay, one more thing. Let me do one thing for your for your clarity. I will calculate selling price inflated first. I would prefer, and in exam you will also prefer to do everything in one step. But here I am, because you may get confused. 275, 275 into 1 plus this. Now, this into 1 plus this equal to this into 1 plus this. So I have inflated the selling price, right? Now, the sales now can be calculated. This into this. Simple as that. Sales can be calculated. Quite straightforward. Now, variable cost in year one, how much? 100. Per unit. Into, then in, yes, again it will inflate with the same rate. If you think I am too quick in any calculation, you can ask me to show that calculation, right? I'll happily show that, the cell calculation. Yes. So total variable cost. Variable cost. This into number of units. Total variable cost. Total variable cost. Now, the next point. Contribution can be calculated now. Sales minus variable cost. This is the contribution. Done. If there is any confusion, you can ask. So, first of all, here 0, 1, 2, 3, and 4. That is contribution. Here is the contribution. Fixed cost increasing 5 rate, inflation of 5%. In the first year, 750,000 into 5% every year. Percent inflation every year. Now, what is next working needed? Next working needed is depreciation, tax allowable depreciation. Tax allowable is 25% on the cost of plant. So annual tax allowable depreciation. What is cost of plant? 18 million. Into 25, because it is straight line. It is straight line. 25%. So 450, 4.5 million. So tax allowable depreciation is only on the plant. Negative. Why we are deducting this depreciation? Can anyone answer? Why this is non-cash expenditure? We have to calculate net cash flows. Why we are deducting it from here? Tell me. Anyone would answer. So why we are deducting it? Non-cash should not be deducted from the cash flows. Why we are doing that? Here. Anyone would answer. Exactly, to reduce taxable profit. We will include, no. When we deduct it, actually, we have to calculate so that tax payment is reduced. So in other words, we are deducting it to claim tax saving, to enjoy tax saving, to enjoy less tax payment. So it is taxable profit. Now we will tax out of that. So tax is 20% reduced tax rate, if you remember here. 20% reduced minus 20%. So tax payment is done out of it. Now we will add back tax allowable depreciation, because we deducted that only for this purpose of calculation of to reduce taxable profit, to reduce tax payment, to account for tax saving. Now add back tax saving is done. So add back depreciation. The same is being added back. What was deducted? Now, the next is working capital. Yes, but we will be doing it. Yes. So these are after tax cash flows. These are after tax cash flows. After tax cash flows or post tax, any you can call it. Now, there is one adjustment remaining, that is working capital. They said 15% of the contribution. So, what we will be doing? Working capital. We need to calculate. Now, so they say it is at the start of each year. If I say, that's why I need to just please. Yes, zero. Here zero should be here. So working capital level. So 15% of this contribution. This is the total working capital required at the start. For year one, here, 15% of contribution and so on. Now, incremental working capital. So initially, this will be the outflow. This will be the outflow. Negative. This minus this. Additional outflow. This is already level, now additional digit. And here it is. So on. Total outflow is here. And same will be recovered here. It will be recovered. Total outflow so for this, it will be recovered at the end of year 4. They said that recoverable at the end of year 4. So working capital adjustment. Here you go. Initial investment. How much it is? Investment is 32 million and 50 million. Now tell me, students, what is the scrap value? You will tell me. What is the scrap value? You will tell me. I can tell you easily, but you will be telling me what is the scrap value. Okay. Two answers received. Read it carefully. This is for land and building, 18 million for plant. The cost of land and building is expected to be recovered. So 32 million, that is recoverable. 32 million. Here, so net cash flows. Here they are. Here they are, net cash flows. If there is any problem, you can ask. The first part of the question, which was 8 mark, it is done. Now, the second part, NPV in dollars. I was expecting this question. I waited it. Listen, the examiner confused you here. Confused you here. It will not have impact. This total variable cost is automatically included the cost of component. It is included, already included. Already included. Both the transfer price in line with inflation. That's it. Automatically adjusted. This information is not relevant in the part 1. Yes, it might be relevant in the part 2, where we have to calculate NPV for in dollars. Okay, but not here. It is already automatically included. A good question, Anjani, I appreciate. This pricing further that is relevant, this pre-tax separate contribution, when we, it is already included here in this cost. Is that clear? It is automatically included already. Right. The next point is B part. B part is, yes. So part A. So part B. Okay, the same we can do. Leave it. Come here. Part B. So part B we need to do, but we need further workings. We need to calculate exchange rates based on purchasing power parity theory. This is here. What is the current exchange rate? 3.31 pound per dollar. So here 0, 1, 2, 3, and 4. So exchange rate, pound per dollar, that is 3.31. Pound, pound per dollar. Now, purchasing power parity theory. This into 1 plus in pound inflation 0.05 divided by 1 plus. There is another way. If you do not want to type too much, you can do this in working here separately. Here, working. It will be very easy. So inflation we have already typed above. One inflation in E. Right? So inflation in US. We can type that as well. 6%. That is again 6%, 7%, and 7%. Yes. So we can write exchange rate. Yes. 3.31 into 1 plus this divided by 1 plus this. 3.31. Now I have generated a formula. Excel formulas, very helpful. Oh my God. Simple is that. It will be less time taking as compared to the typing. Okay, now we can simply write over there. Inflations. Now, the next we will proceed, that is now cash flows in pounds. Yes, cash flows in pounds. Here they are. Sorry. Yes. Now we can calculate in dollars. Divided by this. Yes. Now what is there? What is additional? Additional two things are there. One is there is 20% tax they are paying here. and tax in the US is 25%. So additional tax have to be paid. Yes, I'll be uploading. The student asked the question, will I be sharing this Excel sheet? Yes, I'll be uploading it in the website. The same where the lecture is below that. Okay, at the end of class, I'll be uploading it there. Okay, but you should still try to note down. Otherwise, you will get lost in the lecture. Okay, you will lose connection with the class if you're just watching it like this. Okay, now. So cash flows in the dollars are here. The next point is additional tax we have to pay. What else? There is contribution on component. You know the point Anjani was saying. Component. Then tax on contribution. Because home company is selling that component to the overseas project. Now, the three things are there. So one by one, we need to calculate. Working has to be done for that purpose. Now, so the first thing is, that is additional tax. Tax in US. Please focus everyone. It is a bit tricky calculation. Now, you see here, over here, we paid tax on it, 20%. In the US, it is 30% tax rate. So 10% additional tax which we need to pay. Oh, sorry, 25%. 5% additional, 20%, and 5% additional. So just see here. Focus. What I'll be doing in the year one. In the year one, what I'll be doing. This is the taxable profit converted at exchange rate. This into 10%, 5%, sorry, additional tax. Country converted at that into tax. The calculation is clear to everyone. This one, is it clear? Tell me. Is that clear? This calculation.
Sir, I have one question. In the introduction, it says that M company is based in the US. But when we read now this part on taxation, it says that 20% is in the Iraq compared to 25% in the US. So when we did the cash flow initially, like for part A, should it not have been 25% since we are based in the US?
No, listen. I can understand your confusion. M company is a US-based company. It is investing in Iraq. Okay? So in the Iraq, normal tax rate is 30%. So these cash flows we have calculated for Iraq, that country project. 20% tax rate. IRIT normal tax rate is 30%. But M company, they are giving a favor of 20% tax rate, 10% reduction from the normal rate. So now they will be bringing that cash flows in the US. There they paid 20%. Here is the 25%, so additional 5%. The rule is whichever is higher, you have to pay tax. If you have already paid higher tax in the foreign country, 30%, in the US 25%, you don't have to pay anything additional on that. But in the foreign country, you have paid 20% and you are bringing back to your home country, which in the home country it is 25% in the US. 5% additional to be paid. Got that? Yes. Welcome. 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 So now, so you see here, this is how to be calculated. Additional tax. Simple. This is the beauty of the Excel spreadsheet. Foreign country taxable profits divided by exchange rate or whatever, divide or multiply, whatever is applicable, here divide into differential tax rate. Additional tax in the US. So we have calculated minus this. Now contribute. Component contribution. Again working. Now, what is that? They said that US company will charge, because US company is selling to the IRIT project, this component. They will charge a pre-tax contribution of £10. This is the contribution, £10 per unit. Number of units, how many they are? Number of units, here they are. So this is total contribution in 1 year. In year one. In year one, total contribution converted at this rate in the dollars. Okay, for the time being, keep it. Component contribution in pounds. For your ease, I have done. I would prefer otherwise, in a go. Now, then this are expected to increase in line with the inflation. So 10 in IRIT, it has to increase in line with the inflation of IRIT into number of units. Number of units. Just a minute. I think there is some mistake. 67,000.
It should be 10 into bracket 1.05 for the inflation.
Oh yeah, you are right. You are right. 1 plus this. You are increase now. Increase. You're right. Thank you. Now, the point is that next year, 10 into 1 plus this into 1 plus this 2-year inflation into number of units. This one, 2-year inflation. Yes. Then the 3-year inflation. 10 into 1 plus this into 1 plus this into 1 plus this into number of units. So component contribution in pounds is calculated. Now component, this is contribution in dollars. This divided by exchange rate. Yes. Contribution in dollars. This is income here. In the US. So net cash flows. Yes. Net cash flows in dollars. So present value at the rate of 14%, 14% equal to this into 1.14 raised to power minus this. And NPV that is equal to sum. Yes. Here you are. Any calculation, any point which is not clear, do let me know. So it is done. Calculation is done. If there is any question, you can ask. I'll proceed towards other parts. Now, so students, the next point is we need to discuss the requirement. If we come back to the requirement, the first two parts are done. Impact of the marketing directors. Okay. Alternative exchange rate assumptions. on project NPV, recommending whether or not it should be accepted. Okay, right. We will talk about it. So alternative exchange rate. So let me open a Word document so that I can write a few points about it. Just 1 second. Word document. So first of all, some format we should learn. We said that prepare the report for the board of directors of Mckeever Company, right? So it should be start like that. We start like report to the board of directors of Mckeever Company on the investment evaluation in it. Yes, that's the main point. This is the heading, the first heading at the top. Then is introduction paragraph. Introduction paragraph. Then is evaluation. The first part, this one. Evaluate the impact of marketing directors, what he is saying. Evaluation of project, right? Then is assumptions. Assumptions. Then methodology, concern between, yes, evaluation of project, assumption of the project, and marketing directors concern about methodology. By the way, we can make two subheadings. Yes, two subheadings. Next, political risks. The next, which to be considered, right? Viability of CEO suggestion. Yes. Discount rate, project discount rate. CEO's suggestion for adjusted discount rate to incorporate country risk. Yes. Yes. Anything else? So final conclusion or recommendation about the project. So these are subheadings which I have noted down. Simple is that. Now, students, the point is I will not be typing the detailed answer every word here, but I will be writing a few points over here. So here we will tell that this report considers the viability of a project in ERAT, right? So, and the report is about viability of a project. It is based on NPV evaluation, right? It is discussing assumptions we use for cash flows, okay? And exchange rate assumptions, whatever we are discussing. Directors' concern regarding methodology has been discussed. Political risk attached with the project and its impact on discount rate has been discussed. Yes. So all these points so whatever is going to happen, we have to write all that. But of course, you will not be writing incomplete sentences like this. I am writing just main points. Okay. So evaluation of the project. Evaluation of the project. We will talk about it, but there is some, the requirement is alternative exchange rate assumption. We have not read that. What are you saying? So the expected annual inflation prediction provided in the previous year, but made after obtaining forecasts from the countries for a number of analysts. The analyst prediction varied widely over the period the board is planning to implement the new project. Although there seemed general consensus that inflation is likely to increase in the US and decrease in the Europe. The finance sector has managed the risk associated with these forecasts by attaching probability to each analyst prediction and then calculated the expected inflation rates provided. M companies marketing data has concern about lack of consistency across the range of analyst prediction and methodology used by the finance sector to estimate expected exchange rate inflation. Okay, this is the methodology used. This is methodology used. Consistency, right? As an alternative approach, he has asked you to reassess the project using alternative exchange rates assumptions based on historical trend as follows. However, the finance director commented a weakening of the euro pound rate, Eurasian pound was suggesting by less than 5% of the analyst prediction. Under this alternate exchange rate, an estimated present value of post-tax component contribution has already been calculated as $485. Now, you see here, actually, it is a bit technical over here, the point. Now, what the point is? They say alternative assumption is that pound is weakening against dollar. 5, right? Alternative assumption. And as per our calculation, here it is. Here pound is strengthening against dollar. Here, 4 pounds in dollar. There is serious conflict between the calculation. Now financial analyst approach. As per alternative, sorry. Okay. Exchange rate calculations. Pound is weakening against, while the one calculated expected inflation rates, pound is strengthening against dollar. It is strengthening against dollar. So weakening pound means present value of cash flows in cash flows of the project in it will be very low. Weak because when you convert, you will get less dollars. You will get less dollars because pound is weakening. You have to convert into dollars. You will get less dollars. And PV of the project will also be lower. And it may become even negative. Yes. Now, so students, marketing director, reassess. Historical trend. And what is the prediction? Just a minute, please. The analysts are against it. What they are saying? Because analysts saying the pound will strengthen. So analysts prediction is that inflation will increase in US and decrease in it, which means highly likely pound will strengthen. Strengthen. Yes. If marketing directors' approach is followed to calculate NPV, the project may have negative NPV, which is having remote possibility, means very less chance. While and the company will reject this project if their approach is followed. You know that. Next. So the final decision to take risk with this project rests with the board's attitude towards risk. If the board is risk averse, they may reject it, this project. Yes. But it seemed to be a potentially good project for increase in shareholders' wealth. Yes, evaluation is done. What he's saying, so you see here, we have not written anything from our side. Everything is about calculations. Now, assumptions, second part. Assumptions used. So what are the assumptions? All the units sold, selling price, variable cost, fixed cost, tax, contribution, cost of capital, inflation, right? They are correct. Tax rate remains the same. Tax-allowable deficit remain the same. So yes. So the first of all, yes, first thing we calculated that was the, yes, it is assumed that selling price variable cost, fixed cost, tax rate, working capital, residual value, cost of capital, inflations. Have been calculated or estimated, better word is, because estimations are there, correctly. Correctly. Yes. Inflation, tax rate, sorry. Tax rate remains constant and cost of capital as well. As well during the project life. Yes. Now, secondly, investment has to be taken place immediately and project has 4-year life. These are all assumptions. Lastly, exchange rates in based on purchasing power parity theory. And what was the other point? What was the other point? Analyst prediction. And analyst prediction about inflations. Now, so these are the assumptions we need to write about. They said, write assumptions. Assumptions made. Respond to yes. Concern about methodology. What are you saying? Lack of consistency across a range of one thing, lack of consistency. And methodology used by finance director to estimate the expected inflation rates. Now, 2 points are there. Read these 2 lines very carefully. This one. Understanding is very much important. From this analysis to this. First read this and then this one, please. Understanding is important. What they are saying. Marketing director says different analysts have different predictions. There is inconsistency. So, what we will be saying about concern, 2 things. lack of consistency. Right? So we'll write about it. Among analysts, predictions. Now, what we should do. So the point is, different analysts predict future inflations based on their experience, knowledge, and applied judgments. They apply judgments regarding economic conditions. Of the country. Yes. So there are, of course, limitations of prediction by each analyst as they are involved as they are based on their personal judgments as well. So that's correct. Judgments. Yes. Students, lack of consistency. So this is valid argument. Okay, my laptop is lagging. Just a minute, please. Okay, about methodology used. Inflation prediction. Yes, by finance director. Student, what is the methodology used? I will discuss instead of typing it. Now, so what they have used? They have attached the probabilities to each analyst prediction. Yes. So probabilities are used to incorporate risk. Yes, they'll be used. probability of accuracy of each analyst's prediction, right? To calculate the inflations. And then it has been used in the purchasing power parity, those inflations. So that is a better way to predict future inflation rather than assuming the past will be repeated in the future. The other approach is past trend. Because past trend may not be repeated. It will ignore the current and future plans of the government. So marketing director's approach is to some extent valid, but finance director has used the best possible course of action. Yes, they've used the best possible course of action. Now, so it is done. So you see here, these two parts are done. Recommending whether or not the project should be accepted. So it means we have to tell initially that it should be accepted or not in this as well. So at the start, we missed that. So that's why I always break the requirement into small parts. Always break that down. So initially, we have to start with it that the project has positive NPV of, we have to tell that it's 1.07 million. So under the current circumstances, the project should be accepted. We have to tell that, right? And then, of course, alternative approach we have already discussed. Let me save it, students. Just a minute, please. Word is doing a problem. Just a minute, please. Don't know why. Just 1 minute, please. I'm sorry. Just something unusual for me. Okay, so students, the next part is Political risk the board should consider before making a final decision. You know that when we are there in that country, so many things have been done by the new government. They have reduced dividend remittances. Okay. To the company, the board planned to extract positive cash flow at earliest opportunity. The company, you see here, the government has offered this reduced tax. The government has offered to buy back land. Right? So further information we may get from here, country risk from here, political. M companies board expressed concern about the country's risk with the emerging marketing economy, in particular the foreign exchange and political risk. For example, main opposition parties challenging the tax incentive which have introduced and has overtaken the governing party in opinion poll less than 6 months after the last election. Okay, in the theory, the next is more than 5 years away, but in practice, they have a history of more government changes. Now, these are points. Political risk. One, yes. Yes. Companies, the director's key concern is whether the company's shareholder, mainly institutional investor. This is for the next part. Okay. Discount rate, the next part. Okay, now listen. Students, multiple political risks are here. First of all, recently the government lost an opinion poll even after the 6 months after the last election. So it means there is political instability. We note down these points. Although there are frequent changes in the government, all the elections are held 5 years after, but frequent changes are there. So what will happen if the government is changed? Because there will be a significant risk for Mckeever company if this government is replaced. And the new government places restriction on dividend remittances. So cash flows of Mckeever companies may stuck there. Affecting the NPV of projects. Secondly, the tax exemption may be withdrawn of 10% reduction. The special tax incentive may be withdrawn. Causing net cash flow to reduce. Because from 20% it may increase to 30%. Third, the government offer to buy land and building as a last resort may be withdrawn by a new government. So if at the end of the project they are unable to sell the property, the project may not be worthwhile. May not be worthwhile. So, for you, 3-4 points we have discussed. So, Mckeever company should assess the likelihood of the change of government during the life of the project, that is 4 years. That's it. And then make a final decision of investment. And then make a final decision of investment. Next, validity of CEO suggestion to project use to adjust discount rate to incorporate country's risk. Now, what he is saying here, the CEO questioned whether the discount rate will increase even though project will not involve change country's capital structure. It is a normal course of business. It is in the different country. According to the CEO, this adjustment to discount rate would reflect the increase in the company's risk exposure to the foreign exchange and political risk. Two risks are there. Yes, two risks are there. Students, my Word document may crash, what I feel like. So I hope you have noted down the word, what I typed here. It's not actually, you see, it's stuck. Now, so the point is discount rate. When the company, so how you will write? When there is no change in financial risk and no change in business risk. The cost of, and so in the, despite of that, CEO is asking to increase, to questioning that whether foreign exchange risk and political risk impact the discount rate or not. Now, so firstly, foreign exchange risk is a diversifiable risk that Mckeever Company, if it is facing exchange risk in it, it can do a project in another country. Another country whose currency move in different direction. So it is a diversifiable risk due to which exchange rate is not affected. So due to which discount rate is not affected. Next, the second is political risk. Yes, political risk is that risk which cannot be diversified away. So investors may expect to be compensated in the form of increased discount rate. So final conclusion or recommendation. The project has a positive NPV a project has a positive NPV of $1.1 million. Almost. Yes, almost $1.1 million. So it should be accepted. However, assumptions involved need to be evaluated. Sensitivity analysis can be performed for these variables. Done. So it is done. This question is done. Now, students, the point is, this question is complete. 50 marks case study. Now, I will show you the marking scheme for this question. Marking scheme is here in front of you. Contribution calculation, fixed cost, tax-allowable taxation, working capital, 8 marks. Exchange rate, US dollar cash flows, and so on. Component contribution, so 9 marks. Sorry. Now it's okay. Is it in front of you? Yes, marking scheme is here. Great. So, evaluations. Yes. Assumptions, 3 to 4 months. Lack of consistency, methodology. We have discussed 2 to 3 marks, 2 to 3 marks. Assumptions, 3 to 4 marks. Assumptions, lack of consistency. Okay. Up to 2 marks, well-explained point. Change of government, increased tax rate, withdrawal of guarantee. 2 marks per point. And we have discussed 1, 2, 3, 4 points we have discussed. Up to 2 marks, diversifiability, foreign exchange risk. Okay. Here it is. So you see here, the professional skills marks, report style structure. Answer is relevant. Presentation of calculation, use of appropriate tools, focus to the requirement rather than general. Use of data to discuss. You see, nothing actually, yes. For example, we said that assumptions may be inappropriate. The political risk, we discussed. So that is when we are questioning the assumptions, when we are questioning the points, advice when we give using the logics. Okay, so constraints, right? That's just like we were discussing the when we were discussing the inflations, exchange rates. We were discussing that what they were suggesting, the historical data, its drawbacks, and the practicality actually. So all these things have already been discussed.